Good morning, everyone. This is Dr. Sean Tanger here with the Mississippi State Forestry Extension Service. And today I want to talk with you again about timber taxes. And today we're going to discuss the topic of basis establishment in your properties, as well as adjusting basis and other important components related to your basis accounts, how you can utilize those to minimize your tax burden when you have a sale or a forced conversion of some kind, among other interesting little tax strategies that you can employ. So we gave this presentation last night for the Hancock-Harrison County Forestry and Wildlife Association, and we had kind of some preamble and other things. So I wanted to chop it down a little bit, so to keep the length reasonable. But I just want to make a point. If any of the CFAs would like presentations like these through Zoom, I know we're in the age of COVID right now, but I'm still in business and still open to doing any presentations for CFAs that need it, or even day-long programs, things like that. Just please feel free to reach out to me and we can try to organize something. So anyway, with that, let's get started. Okay. So, you see the title here. I just want to make a couple of points. Again, I always have to put this out there. I'm neither a tax attorney nor a certified public accountant. Nothing should be construed as legal advice in this presentation. This is merely for educational purposes, and hopefully with the outcome of getting your vocabulary and understanding of this concept strong enough to where you as a timber landowner can now talk in tax jargon with your tax professional, but also bring in your forestry knowledge that many of them likely will not have. Some will, but you want to make sure that they know the unique aspects of forestry as it relates to the tax code. Again, anything regarding any tax questions that you may have, or specific to this presentation, or more general, please feel free to reach out to me by email or by phone, and I'll be happy to consult with you or point you in the right direction for the information you need. So I guess we just need to start out with describing what basis is. So generally, this is the amount of your capital investment in a property for tax purposes. And this is the cost to purchase or acquire said capital investment. So oftentimes when you purchase a property, obviously we're talking about timberland here, you're going to have costs beyond just the purchase of that property. You're going to have things like legal fees. You're going to have timber cruises, perhaps. Those would all be definitely recommended. And overall, those are going to add to the total cost or purchase, the cost of purchase or acquisition for that capital investment. And you would include those in any basis establishment into your relevant accounts that we'll talk about here shortly. So why is basis so important? Well, you're really going to use your basis to figure for the different capital assets that you're going to, to be utilizing or selling off, or some sort of disposal or otherwise as you move along your property in order to turn a profit off of it, right? So things like depreciation for equipment, amortization for reforestation costs, depletion whenever you cut a portion of your timber or all of it. If you'd have a casualty loss like a sudden storm or fire on the property, having basis can help you reclaim some of the loss that you've incurred on said property. Any gain or loss on a sale that you may have, an exchange or other disposition of property. So, outright sale, of the land and everything. So you can see here a description of various land accounts and the method of capital recovery. We won't spend a lot of time here. We're just really kind of pointing out sort of these typical things that you might see. And you can see, if you have initial basis, how are you actually going to determine how much basis is in each of these accounts. So you're going to have a total basis that you're going to have in this forest property. But then you're going to have these various categories which are going to get parts of that overall basis, right? That's your total figure. And then you're going to put, portions of that total into various accounts, depending on what properties, you may have. If you do have a forested property, you're going to have forest land, obviously, but you may have some farm property associated with that. I spoke with a landowner the other day that wants to purchase some forest land, but it also has a pecan orchard and a blueberry setup in it. So you could have more than one type of land on the property. Non-depreciable land improvements, so things like permanent roads, land gradings, or impoundments. Sometimes these can be difficult to parse out if you purchase the property with them already on there, in which case you potentially could put it just in your forest land account and not in the non-depreciable improvement. But if you add one of these, so let's say you put in a permanent road, then you can put that in a separate account in order to be more flexible with your dispositions and things of that nature. Also, depreciable land improvements. So lots of times, culverts, gravel roads, fences, fire breaks, temporary roads, buildings, those sorts of things. Those are going to be improvements that you make, maybe before a harvest. Maybe your some of your objectives change as you go through the property or over the life of the property. And you would also be able to add those into one of the accounts and then depreciate that over time in order to claw back the basis in the from the cost that you incurred to put those in there. For your timber accounts, these are the most typical ones that you'll see. Obviously, merchantable timber, which if you're in the South, we're thinking of something that's anywhere from 30, if you're small landowner, 30 up to maybe even 60 or 70 years old, or longer, perhaps if you're dealing with a hardwood stand. But typically, if we're talking pine plantations or natural stands, anywhere from 30 to 45 years, and within that, right, you're going to have separate you're going to have different types of merchantable classes of products. So, hard pulpwood, chip and saw timber, poles. If you have hardwood, you might get veneers and things like that if you have good grades. And with those, we're going to be able to, as we harvest those various products, we're going to be able to deplete those, by however many number of units that we're going to harvest at any one time. And those can be listed as 1,000 board feet, cords, tons. It's really up to you. And if you want to list different products with different units of measure, so say you have pulpwood and you want to do it in tons or cords, you have saw timber and you want to do it in 1,000 board feet, there's nothing in the IRS tax code that says, oh, it has to all be one or the other. You can mix and match those, but you need to be consistent with them. And if you're going to make changes when, say, pulpwood becomes saw timber, you're going to have the added complication of having it move into, because in your merchantable timber account you could have a pulpwood account as well as a saw timber account. So obviously pulpwood's going to grow. Whatever you don't harvest in your first and second thinning is going to grow into a saw timber class wood, and it would by the second thinning as well. But as it grows into that, you have to document that wood no longer is in a pulpwood account and then it's in the saw timber account. And you'd have to do that with a cruise of the property. Okay, pre-merchantable timber. This is going to be an important one because a lot of people don't realize when they're setting up their basis accounts, because there's no market. Obviously, it's pre-merchantable, right? In the description, I can't merchandise this product. But if you don't account for it when you do your basis establishment and set up your various accounts, you typically will overestimate the amount that you have in your land account. Okay, so you'll put too big a percentage in there. And why is that important? Well, because land's going to be the last thing that you get rid of, right? If you're purchasing timber and you're a timber property and you're planning on harvesting wood, well, this first, second, and even the final harvest, those first two thinnings and the final harvest are going to come before you dispose of the land, if you do at all. So you want to, with what's legally required, you want to put as much in your timber accounts relative to your land accounts. Okay, and we'll go into that in more detail as we go on. Lastly, there is, with a technicality, there is a timber account for reforestation. The reason I say technicality is basis. Unfortunately, when you buy a property, especially something as long-lived as timber, your basis account, when you allocate into these various categories, unless you do improvements and then capitalize them and put those into the accounts, your basis is going to stay relatively unchanged if you don't do any disposition of any kind or deplete timber, etc. And so over time, what happens, right? Well, your timber property is going to, if things are going good in the economy, your timber property is going to appreciate in value, right? Both the land as well as the trees, because the trees are growing and they're moving into these nice new categories where I can merchandise the property. But your basis account stays the same. So in that way, inflation is eating away at your basis as you go. So what you want to do as a landowner, if you're being strategic, is you want to put, again, as little into this account and as much into this one, so that you can get that base, you can utilize the basis as soon as possible. Because whatever you can expense away and take deductions in that manner, you're really going to have to figure out the quickest way to get rid of that basis in order to get the tax benefits of it that aren't, eaten away by inflationary effects. Okay, so with reforestation, you're going to, the great thing is we have a good reforestation tax credit here in the state of Mississippi, and you have a federal reforestation tax deduction, and those two work in conjunction to really allow you to make a lot of aggressive moves, perfectly legal aggressive moves, as soon as you have a reforestation cost, to get those costs back, at least in part, to reclaim that money through the tax code. Okay, so excuse me. Another important topic we need to discuss for the sake of basis is the qualified timber property. So you can see here the description from the IRS tax code 194C1. A woodlot or other site located in the U.S. which will contain trees in significant commercial quantities and which is held by the taxpayer for the planting, cultivating, caring for, and cutting of trees for sale or use in the commercial production of timber products. Now, I'm going to simplify that greatly. That's a long way of saying basically anything that is, commercially viable and for production of timber for sale. Now, the interesting thing, right, is it says in significant commercial quantities and for sale of use in commercial production. In actuality, as far as the IRS code is concerned, the minimum size for what they consider commercial timber production is 1 acre. I don't recommend buying 1 acre and trying to make a go of it. I don't know of many acres that are gonna come out by themselves netting you a profitable return. And if you're gonna describe yourself as a business or an investor, which means that you have a motivation for profit, then you better make sure that you can validate that profit motive with your management plan, and as well as some sort of discount cash flow model over time, showing when you expect harvest, the prices that are going to be expected, and your consultant can help you with producing all of that. But it would be good for you as well to kind of have an idea of, not just rolling the dice and we expect, hopefully we get some revenue streams in terms of, taxes. And so you don't get kicked back into being a hobby owner. at some point. You want to be able to establish and feel good about that profit motivation. Now, there are things beyond our control, and there's a certain risk associated with owning any capital asset. You won't run afoul necessarily of the tax collectors if your business or investment doesn't end up being profitable. It just means a lot of the nice deductions and or statuses that you would enjoy when it comes time to enjoy them, you won't be able to if the IRS determines that no, this indeed isn't a capital asset for profit motivation. And we'll get more into that in a different presentation. Okay. So when it comes to qualified timber properties, you have a lot of flexibility in terms of how you define them. So most people, when we think of small landowners, I'm thinking somebody with 50 to 100 acres, most will have one qualified timber property per taxable entity. Okay, so that means you own 100 acres and the whole thing is listed under one QTP. Okay. Now, the tax advantage there is it's a lot simpler. Okay, so especially if you're an investor, you don't want to spend a lot of time dealing with these books. And again, every cost you take on, right? You have to have a revenue in order to be profitable. So if you want to minimize your costs, one of the big costs is record keeping, and either you're doing it and spending your time, or somebody else is doing it and spending your money. So one QTP is much more simple. The other advantage, and this is very pertinent for people, in areas where storms are common or fire may break out. If you have a casualty loss where you have a sudden, unexpected, an unusual event, then those bases can be utilized. If you trigger a casualty loss, you can use basis to offset ordinary income in that case. And if you're more interested in that, at the end, I'll have a link on sort of the synthesis between basis and casualty losses. It's a 45-minute video, but it should be very enlightening to you if you're interested in that topic. Okay, so in this case, you only keep one account for taxpayers. The alternative is each tract would be a separate qualified timber property with its own quote-unquote X identifier. Okay, so let's say you had a pulpwood stand that was planted in 2006 and a hardwood stand that you purchased in 2005. Okay, whether it be saw timber, pulpwood, whatever. Maybe it's a naturally regenerating stand, and it was had just been a final harvest had just been conducted before you purchased it. In that case, both of those can qualify as timber property or qualified timber property. The issue there is you would need to keep a separate account for each QTP, and when we say QTP minus X, or each identifier. Okay. Now the tax advantage here is on your reforestation deductions, and for Mississippi, your tax credit. You would get to apply those to each property as from a tax standpoint as a completely separate property, even if you think of them as being the same, same timber property. From a tax standpoint, they are considered unique. So you can do, if you want to, if you're kind of curious, well, how do I distinguish? If I want to have multiple QTPs, how would I distinguish what's within the what's within the IRS guidelines? And a warning is that your QTP must be sound business practice and not arbitrary. So you can't take half a saw timber pine stand and chop it in half and just say, well, that's two QTPs because I'm doing a final harvest and I want to get double the reforestation tax credit or a federal tax deduction. But you can set it up based off of things that are biological differences or geographical differences. Okay, if they were actually Non-contiguous, that could qualify if they had different tax parcel numbers. From a biological standpoint, if there were site prep differences, planting differences, okay? Any of those would be satisfactory. There have been people in the past who've been as aggressive as, hey, these properties are on different soil types. Okay, well, the IRS has ruled in some cases that that's okay. There's not any hard and fast rules on switching back and forth that I'm aware of. I've reached out to some other tax professionals to see about that, but I would be cautious in switching back and forth very often. As is true with all the tax code and your behavior with regards to the tax code and tax enforcement, you want to be very deliberate in your actions. You don't want it to look like you're engaged in, that you're trying to work the angles too much. Not that it doesn't, that you would get necessarily in trouble or that you wouldn't be able to do it, but it's going to draw scrutiny, okay? The more tax breaks that you manipulate for your advantage, over and above what the IRS sees as ordinary and necessary kind of activity and practice, it's going to draw some more scrutiny. So there is no hard and fast rule about switching, from one QTP to multiple to back, but I would recommend extreme caution in that activity. There may indeed be rules on it. I've just not been able to find anything through looking through the tax code. But as you know, it's vast, and I very easily could have missed something. Okay, next thing we need to talk about is the IRS's Form T, or timber. You're going to keep one of these for each qualified timber property that you decide to have. Okay, and today we're going to assume, as we go through our examples, we're going to assume that you only have one, okay, for simplicity's sake. But the rules apply either way if you have multiple or not. Okay. So there's four main categories. There is a fifth category. It's not pertinent to today, but of these four, we're going to talk about these three. And the fourth one, I've got a presentation on reforestation specifically that I'll cover that one in the next presentation. But for today, we're going to talk about acquisitions if we deplete timber and if we have a profit or loss from land and timber sales. Okay. Now, this info is critical for records, and oftentimes you are going to need to officially file your Form T, but most years you're not going to. Okay, but because it's very important in terms of keeping records, you want to complete it every year as if it's required. Okay, and most of the sections, if you're doing it every year, most of these sections there might not be any activity, but it's important to keep up with it, because when you have your basis updated to its most current, you're going to be the most able to take advantage of whatever basis you have in order to reap tax benefits or respond to tax implications such as a casualty event that maybe you weren't expecting, but now you're more mobile for responding to it because you've already been doing your due diligence on keeping your records as recent as possible. So when should you actually file a Form T? The only times that you have to are when you claim a deduction for depletion of timber, or when you do a sale of some kind with your timber property. Okay, and these two categories we don't really need to get into today. As a small landowner, if you're not a timber business where you're logging your own property, there's really no need to get into the weeds of 631 A's and B's at this point. But basically, if I'm going to have a sale of exchange, or I'm going to harvest some timber of some kind, that's when I'm going to need to send that Form T in with the rest of my tax returns. Okay, so here we're looking at the Form T for timber, and you have your basic forest activities schedule. And in part one, again, we mentioned we're talking about acquisitions. So in that first category, you're going to have the name of the block and title of account. So block these are kind of synonymous terms with whatever QTP that I'm actually interested in. Okay, you can see here. So we have an example QTP with a special identifier like PP5. Remember we mentioned that one previously. So I have a pulpwood stand that I potentially planted in 2005. Okay, location of property, name and address of seller or person from whom the property was acquired. So the acquisition of the QTP, that's going to be important for establishing initial basis, because we're going to then need to know, hey, how did we receive this property? Did we purchase it? Did we inherit it? Was it gifted? Like-kind exchange, those sorts of things. If we did purchase it, how much did it cost in cash or some sort of check or something? And then how much of it is on money that we borrowed from some lending authority? That's important because whether you're a investor or a business, you're going to be able to, any interest that you accrue on that, you're going to be able to expense, well, not accrue, sorry, any interest payments that you make, you're going to be able to deduct those on your yearly tax returns. And if you're a hobbyist, unfortunately, you won't be, but you'll still want to keep this form. I would recommend it. I would keep this form if you're a hobbyist or not, because as a hobbyist, you still do get capital gains treatment on any timber sales that you conduct, which means you can subtract basis from any of the taxable revenues that you generate from this harvest. Remember, I mentioned before, so you're going to pay cash or some combination of cash and loaned money to buy the property. And you're also going to have costs associated with the purchase of that property that are not just the property purchase, right? You're going to have legal expenses, contracts, lawyer fees, things like that, cruising, surveying, what property, what is the property, what's on it, getting a feel for what's out there that's valuable. All of those would be calculated in that initial basis, when you're acquiring it, and could be as well for some of these other categories. Okay. And then lastly, you just add those lines up and that'll give you your total initial basis. Now you have to go through the process of putting it into separate accounts. Before we get to that, let's cover the different forms of initial basis and acquisition. Okay. So we can see here, excuse me, perhaps you inherited the property. In that case, if you purchase the property, fair market value will not be used to establish your basis. Well, we'll get into this example later. It will be used, but not directly. However, if you inherit it because you yourself didn't purchase the property, the only value that they have to go on would be the fair market value of the property. And that would be assessed through some form of assessment. And county assessors' offices could have some of that information. We'll show you some of the different authorities that are used in order to establish those what fair market values are. If it's gifted, now there's some reasons why you would gift over inheritance, but they're most often, if you want to set your heirs up with the best possible situation in terms of basis, you're going to want to go with inheritance over gift. But if it is gifted, it would be whatever the donor's basis was at the time that the gift was received to the new owner. Purchased, we've kind of talked about, so the acquisition cost that we went through in that acquisitions for Form T, Part 1. Like-kind exchanges, so there's an exchange of two timber properties. Whatever the basis is in the original property traded, plus any cost, plus any boot, or if you have to sweeten the deal, or when you exchange, the other person has to sweeten the deal for you in order to make these two properties quote unquote equivalent, then that would also have to be taken into account. One thing before I forget, for the inheritance, if it's fair market value, you see this little asterisk here. If you're a surviving spouse of a jointly held property, 1/2 of the fair market value for the surviving spouse. So if your spouse dies, your basis isn't affected, but you're able to take the their half of the basis and step it up to fair market value. So it is a way to give you, as a surviving spouse, a little bit of a financial boost in terms of the property. Lastly, planted, and basically what we're talking about here is for reforestation. This is really one you don't see discussed very much, but just to be complete, when we say it can drop to 0 within 1 year, that has to do with all the reforestation incentives that you'll have at your disposal, both federally and at the state. Oftentimes, that initial basis gets eaten up very quickly, and if not within 1 year, then certainly within the 7-year window that you get to amortize that reforestation cost. So you can see here we have a inherited property. So the donor's basis is $10,000, and you're trying to figure out what your basis would be. Well, again, you didn't purchase it, so you can't use a cost method. And fortunately, you're actually able to use fair market value in this case. So you can see really quickly, whereas the donor had very little to work with in terms of their basis, this fair market value rule gets to, it helps you as the new inheritor basically overcome all those inflationary effects that I mentioned earlier on in the presentation. So this is a really, really good setup for passing property down. Okay, for gifted property, as we mentioned before, the basis, unfortunately, in this case, is only a carryover value and not a stepped up value, as is in this case. So in that world, the donor's basis is going to be passed on to whoever receives the property. And again, for purchased property, a lot of times people say, oh, well, you know, the fair market value, why do I only get to use the 70? Well, look at it this way. The 70 is much more beneficial to you in many ways, right? You paid $21,000 less in purchase costs than the fair market value. So, you know, yeah, you don't get the benefit of having $91,000 in basis, but you didn't have to pay $91,000 for the property. So people oftentimes are a little weirded out by, well, why are the acquisitions costs so much different from fair market value? Well, there's some valuation reasons why, but you know, if we just think about it in terms of different scenarios, you know, let's say that you purchased a property from a child who, or not a child, but an heir of a property that had just inherited it and is looking to liquidate very quickly. Okay, and the fair market value is $91,000, but they want cash and they want it right now. So oftentimes people will take a discount on the property in order to expedite that transaction. Okay, why might it be more? That's possible too, right? Your acquisitions cost could be a lot more than fair market value. Well, let's say you had 100 acres of timber and there was 100 acres right next to yours for sale. There's an advantage to you beyond that extra 100 acres, right, in and of itself. There's a added benefit of you hooking those two properties together, right? Now you have 200 acres of contiguous property, and that makes you a lot more attractive to logging operations, things like that. Gives you a little bit more leverage in negotiations. So in this case, you know, all that said, in this case, your purchased property, your basis would be what would be called a cost basis. So just be the acquisitions cost of the property. Okay, now each qualified timber property, there are 3 primary asset accounts. Okay, I mentioned these before a little bit: land, timber, and improvements. So let's look at those in terms of how we set those up. So you can see here for forest land. Now this isn't the trees; this will just be the land underneath it. Okay, remember this was our lines 4A through 7, so our total basis. And now we want to distribute that basis among the different capital assets and other assets that came along with the acquisitions cost of that property or properties. Okay, so we would have timber basis, land basis, pre-merchantable timber basis, and then any depreciable asset basis for things like buildings, fences and gates, tractors, even you know, sort of these improvements that are not permanent, so culverts, gravel, and bridges. Okay. So we already mentioned these different accounts and how we're going to recover that basis as time goes on. And we don't need to focus too much on this table. Let's get on to our form T, and we'll see these how this factors in a little bit more here. Before we do that, we need to figure out, in both of these cases, okay, we know what our cost basis is, right? Because that's what we purchased. So we know that number. But we are going to need to know fair market value nonetheless. And the reason we're going to need to know that is because fair market value is going to be used to give us our percentages that we're going to distribute the overall basis into these different accounts. Okay. And I'll run you through a quick example, so that'll be fine. But where do we go to find out what fair market value is? There's a few different ways, but a real cheap way, and one that's recognized by the IRS, is simply going to a tax assessor and appraised values for whatever property that you purchased or are purchasing. Okay. Now, so let's talk about the land first. A reminder: when buying real estate property for business or investment, so profit motive, the buyer must allocate the purchase price between land and buildings. Okay, so we saw that here, right? So here's our land, and here's our non-depreciable and depreciable land improvements. Okay, so I would need to, if I could, split these up. Again, for this one, you may not have records for this. They would just go into that land account, but depreciable ones, they should be there in the form of what you would see here, improvements. Okay. Local assessments for realty taxes are a good measure of the values of the building and the land, as shown here. And you can see during an audit, the service relied on county assessments to figure the cost apportionment between the value of land and improvements. The tax court said IRS's allocation was proper. So, right, that if you know that this is kind of accepted way of doing things, then it's not very costly for you to go to the tax assessor's webpage in your county and figure out for your property these different appraised values, so you can figure out where your the portions of your land accounts need to go. Timber is a little bit more complicated, not a lot. One thing you can do if you want to get a fair market value for merchantable timber, again, not non-merchantable, we'll talk about that one next, but for merchantable timber, you're going to have, in order to establish fair market value, it's going to be the tons of the product, or excuse me, whatever units that you're using, be it 1,000 board feet, etc. But you're going to multiply those by the price, and that's going to give you right a revenue, or the portion of a basis that's going to go into that mature timber account. Now, as it says here, sales of similar property comparable on or about the valuation date are the best indicators of fair market value. Irs Audit Guides. There is a IRS Hardwood Audit Guide that I have in the references that I'll point out to you at the very end. Even though it says hardwood, it's also utilized for softwood, and it gives you, the rules for how you can go about establishing your basis in any mature timber. And by mature, I mean merchantable. So it could be pulpwood, could be saw timber, etc. Okay, so you could go to the Secretary of State's webpage. You go under this Public Lands tab, and it allows you to choose quite a few different options to figure out certain time periods, counties, whether or not it was a final harvest or some other form of harvest, what species were involved. You can really get pretty fine-tuned. And so that's going to allow you to feel really comfortable, if the IRS, audits you for some reason, to feel really confident and comfortable. Well, hey, this is what properties for similar DBH hardwood pulpwood was going for at the time that I established my basis. And here's how I did it. Again, back to that idea of being deliberate and obvious with what your actions are. This would keep you in the good graces with the IRS. If you want historical prices, because a lot of times maybe you're doing a retroactive basis, which we'll also talk about here in a minute. If you're doing a retroactive basis, this data might not exist if you go back far enough, right? So if it doesn't exist and a consultant that you're using doesn't have good records for the area, then one thing that the IRS does allow, again, they will scrutinize it more, but they would allow you to use historical prices that you could locate through Mark Mazel's from the MSU Extension website. He can give you those historical prices for your region. Problem there is they're regional and they're not specific to your county, and they're not specific to comparable property. Those prices are all averages, just like if you went and purchased those historical prices from one of the various price providers like a Timber Mart South or a Forest Market. They're not going to, even though they'll have the classifications like pulpwood, saw timber, chip and saw, they're not going to have average DBHs. So there may be a little bit more scrutiny. They may still allow it, but there might be more scrutiny on, well, when you purchased that pulpwood, was it, was the DBH 8? Things like that. And in that way, you could play games with, the fair market valuation for the timber and the land accounts. So if at all possible, you want, this kind of information. But again, you take what information you have that's best and then hope for the best, right? But that's just a caveat that you need to be aware of, okay? Now, remember I mentioned for immature timber, so what we call pre-merchantable, right? It's real easy for these other categories like pulpwood and maybe chip and saw timber stuff. It's much easier to establish my basis based on product values because, right, we've got things like this and the price reports from Mark and or consultant records that they have from sales that they've done. In that case, it's pretty easy to put my basis in my various timber accounts, whether I'm doing them all in one, which you can blend them, pulpwood and saw timber, or you can keep them separate. But in that case, it's very easy to point and say, hey, this was why we put this much basis in that account. With immature timber, it's much more difficult. As you can see here, even up to ages 9 and 10, where there's no product value on this pine plantation, it actually does have inherent value, and there are formulas that are used, specifically this land expectation value, that can basically run either forward or backward, can run the value of that immature timber at the time that you bought it. So if you had a 7-year-old stand of immature trees, and then you also had some pulpwood and maybe some saw timber, you could still put basis into this immature account based off of this financial formula that most of your consultants should be able to do. If you want to learn more about that, you can go to this book by Bullard and Strotka called Basic Concepts of Forest Valuation and Investment. That's free online. It's quite a big book, but if you just search through the either the index or at the beginning in the table of contents, you'll be able to find how that's calculated. And it's actually, it's a good book, even if you don't have much background or any background in how to do these kinds of analyses. It's very easy to follow. So I recommend having that just for so you know the jargon when you're talking with your consultant and you're trying to establish these different accounts. hey, do you know how to do this land expectation value so we can get a valuation for my immature trees? And they should be able to do it. And if they don't know how to do it, then that you need to make sure that it gets done so that it's calculated and you don't over proportion your land account in that case. And you also don't want to put those into your mature trees because, right, they're not mature yet. That might run afoul of the IRS, and there might be unfortunate disadvantages for you, even if they are okay with it. There'd be, it might draw down. It would make doing your basis very complicated, and it wouldn't be correct. So you don't want to go that route if possible. Let's look at a quick example here. We have here, this is a little timber tax humor. We have Elliott Slash. If you like your scientific tree names, you'll pick up on what that name means. Purchased 40 acres of forest land for $70,000. This includes all acquisitions costs, so straightforward, simple example here. And pine saw timber tonnage totaled 2,000 tons. So based on those last things we talked about, an appraisal showed that the fair market value of the land was 40,000, timber was 51, and the total fair market value is 91,000. Now, here we have the fair market value, and we have the different asset accounts, and we have the totals, okay? So let's look at this here. We want to know what the proportion that goes into each account is of fair market value. So simply take what's been apportioned into each account and divide it by the total, and that will give you these percentages, okay? Always make sure that your percentages add up to 100, okay? That's, sometimes people can get a little funky on those, and you can either overestimate or underestimate your proportion in your accounts. Now, we also know that the total acquisitions cost was $70,000. Now, I don't know that person who I purchased that property from valued the timber and the land in any particular way. They may have, and maybe they do have, they would be able to give you that information, but it'd be kind of irrelevant for the establishing basis. You would simply take that total allocation cost, multiply it by the percentage for that account, okay, excuse me, and then that would give you the actual basis allocation in that account based off of your acquisition price, okay? So you use fair market value to establish your percentages, and then you use those percentages and multiply them by the total allocation basis to then start to proportion into your relevant accounts, okay? So we're moving through that Form T Part 1 acquisition. Here's 70,000. Again, we had that from our example. We also had our 30,800 from the formula that we calculated, and we also know the number of acres. So now we can do a per unit basis in that forest land account. So if I ever decide, once I cut trees off of 10 acres and I want to sell it, well, once I sell that forest land, now I'll have my basis that I can then apply to the 10 acres, okay, because I have my per unit. So take 77 times 10, and then I'd be able to subtract that, from any revenues that I gained to lower my tax burden. So that's important to establish that per unit basis. More so for the timber account, we can see here we have the 39,200, okay, that we got from there. And we also know from our example that we had 2,000 tons of saw timber, okay? Now we take this and divide it by this, and that will give us what's called our depletion unit. Same way from up here. Now, whenever I harvest saw timber, if I don't want to harvest all 2,000 tons at once, I can use this depletion unit, multiply it by the number of units that I do harvest to know how much basis I can subtract from any sales that I have for the property. In this case, right, a timber harvest. Okay, mentioned this before, with the historical prices. What happens if, and this happens quite often, unfortunately, a lot of times landowners will harvest trees and then they'll go to their tax person and start to set up all the documents. And then the tax person will tell them, well, what was your basis in the timber? And they don't know what the person's talking about, okay? Even if your tax attorney doesn't understand the Form T or the particulars of timber, they do understand capital gains and basis in accounts. And so they're going to, this question will pop up. Now, if records do not exist to determine timber volume at the time of acquisition, forest measuring and mathematical techniques can be used to reverse the growth of the current forest back to the date of acquisition for a reasonable approximation of volume. Again, you'll want to look at this IRS Timber Industry Audit Technique Guide, and don't be scared away by this that says hardwood. If it's for, if you're looking at a pine stand, it's still relevant to that. Now, you're going to need, and here's another thing, you're going to need a certified, maybe not certified forester, but certainly somebody who can show bona fides that they are qualified for doing a retroactive basis on your property. And in Mississippi, I'm not 100% sure of this rule. It may be required that that person be a certified forester. So it's not in all states, but you'll want to make sure to do that. In short, you want to use whatever practices are typically used in order to establish these based on precedent. Now, I've heard consultants say, well, we had some drones and we flew over and we used, some fancy software and we were able to do a retroactive basis for somebody. Well, you might have been able to do a retroactive basis, but if the IRS ever sees that, they're going to reject it because those are techniques that are not, through court rulings have not been, or they're going to try to reject it. Through previous court rulings, that has not been established as the proper technique for measuring and reversing growth back to the initial conditions when you purchase the property. So make sure, and I'm happy to help you with this if you want to establish it. What do I need to do a retroactive basis appropriately? Anything that sounds super cheap, if you have a regular reasonable timber stand, it's probably too good to be true. These aren't cheap. They're not terrible. And of course, it varies by individual. But if you want to establish basis retroactively, there are certain steps and techniques that are required, and you may be able to float in underneath the long arm of the law, so to speak. But it's just a chance you don't want to take. Okay, so let's look at an example that shows us how to determine retroactive basis. So we have here Betula White, another funny code word here for a type of timber. Inherited 50 acres for timberland 10 years ago. This year she paid $500 for a retroactive appraisal for land and timber. The consulting forester determined the present saw timber inventory at 5,000 tons, and past timber growth averaged 2 tons per acre per year. And that's a common rule of thumb. It's not, again, depending on how good your site index is, it could be less. It might be a little more as well, and depending on any activities that were undertaken as far as competition control or some sort of boost to the potential in that like a fertilizer or something, so boost the potential in that particular soil. Timber prices 10 years ago were $25 per ton. Comparable bare land was valued at $600 per acre 10 years ago. Okay. Now this one we're going to spend a little bit of time on because it's a lot of steps, but we can see here from our example, right, our initial inventory. Now, when we say initial here, we mean what we currently know, right? And we're going to have to, basically, we're doing an algebra equation. We're solving for X, right? The previous thing that we want to know. So we know that we had 2 tons of growth per acre per year. We know we had 50 acres, and we know that there were 10 years in between when I got the property and from now. So I have 5,000 now. I subtract 1,000 because that's what I'm going to get from the growth, right? From this little formula here. And then I'm going to start then 10 years ago with 4,000 tons. Okay. So that part 2, estimated quantity of timber and cost or other basis returnable through depletion at the end of the preceding year. So if you were initially establishing this and you knew the 4,000, that'd be your starting point, but we're kind of having to work backwards because it's retroactive, right? Now, What else do we know? We know that 4,000 tons at the time, each ton was valued at roughly $25 per ton, and that would be $100,000. So you now have established your initial quantity and your initial cost basis. Okay. Also, since we're moving into the future, right, or back into the future, the present in this case, we had to have the appraisal come out there to figure out what the retroactive appraisal for the land and timber was, and that was $500. Okay, just for sake of argument, we're using that figure. And of that 500, 385, as you can see here, went to the timber account, right, to actually measure the timber and not to retroactively figure out what the basis in the land was. Okay, so we can see here we have our 5,000 tons. That's what they measured as being current. And we have our basis from 10 years ago, and we have our added cost that we can add to the basis in the form of the appraisal. Because remember, it wasn't done before. And I said earlier, when you get your initial basis done, you're able to add legal fees, cruising, those sorts of things. So you're still able to add those. You don't lose them just because you're doing this later. Okay. And then we take the 100,385 divide by 5,000, and you get your new depletion unit. Okay. Here we go for based on that same example. So we have the 130,500. Okay. Again, now we're going to split that $130,500 into our forest land and our merchantable timber. Again, fairly simple example because everything's merchantable and we just have the forest land. So we would take that basis in the forest land. We know what we have in timber right from here. Okay. And I'm sorry. And we know what the total is. So whatever's left has to go into that land account. Okay. And you run these the same way. We have the basis, we have the number of units that give us a per unit basis. Likewise for the timber. Okay. And that would be our cost basis, at the time. Okay. So 100,385 divided by 40, and you get that 2510. Okay. So adjusting basis over time. Basis will increase if we have capital improvements. So if you scrape a road, if you, replant your forest, if you put a house on the property, something of that nature. Carrying charges, so those are those interest rates we talked about, or carrying charges could also be property taxes, or other costs that you could deduct in many cases if you're a business, and in some cases if you're an investor, but you capitalize them. Okay, lots of these things can be capitalized. It's a little more strict in terms of if you wanted to expense those costs, a little more strict for the investor as opposed to the business. But we'll talk about that in a future presentation as well when we talk about forest expenses. Also decreases as allowances for depletion. So when I harvest timber, right, if I'm going to want to subtract that from my revenue that I pull in, then I'm going to have to decrease my basis based on how much depletion I incur. Amortization for my timber, reforestation efforts, and there's some other things, or depreciation on things like equipment and non-permanent structures, or non-permanent improvements, I should say. And the remainder is going to be our adjusted basis. Okay, so one last example here. One qualified timber property or a blended timber account. So 5 years ago, Stella Oak inherited 1,500 tons of saw timber and 800 tons pulpwood valued at $50,000. Timber grew by 700 tons in the past 5 years. This year, Stella thinned her timber and sold 600 tons of pulpwood for $5,000. Okay, so here we go. We're going to adjust our timber basis, right, after selling some property. So we have here our initial basis of 50,000, right? We inherited 1,500 and 800 for 50,000, and it was 2,300 tons. I don't know why I have toppins. That should be tons. And we have our additional growth for the number of years covered, right? We added 700 tons. And at the end of the tax year, that would be 3,000 tons. We still have, you carry that basis down unless we added anything in here, which we didn't. Okay. Again, take this, divide by this, get the 1667. Okay. Then we know the quantity of timber, standing timber that we sold. That was 600 tons. So to get this, we take this and multiply it, right? And that's going to give us this 10,002. Now, the advantage here, you're harvesting pulpwood. Again, we talked about trying to utilize basis for tax purposes as quickly as possible. You're actually helping yourself by blending these accounts, because even though I'm going to cut pulpwood typically before saw timber, right, the 1667 has baked into it the value of whatever saw timber I have on the property, right, because we have this whole 50,000. So in that way, I'm able to deplete my pulpwood at a much larger per unit rate than I am if I had two separate accounts that were unblended. So that's a tax strategy you can implement if you so choose. Now remember though, the basis I take today is basis I can't take tomorrow. So if you decide to do this, keep in mind, right, when you go to do a saw timber harvest, which is potentially and hopefully, right, if things have worked out well, going to have a much larger revenue than the pulpwood revenue, and you're not going to have as much basis because you've blended the accounts. But there may be reasons why you need that deduction more currently based on your unique tax circumstances. So there's not a rule of thumb as to whether you should blend or not. But if you want basis as quickly as possible to recoup your capital expenses or capital cost, then this is a way that you can speed up that process. Okay, so we can see here, again, I've kind of already explained this. We take the 600 multiplied by the 1667, and that's how we get, what we can deduct from that timber sale. Okay. And then lastly, once we've gotten rid of that 600 and that 10,002, you need to remember, we said, for tax records, when you need to be keeping up with that timber form and adjusting your basis. Well, after you've had a sale, you need to reallocate the basis that's left with the tons that are left and establish a new depletion unit. Okay. Now, part 3. This is another really important part of this, and this is the last section that we'll cover for the Form T. So we sold 600 tons of pulpwood for $5,000. Okay, that's fine. But the real advantage here is, okay, we had our 600 tons, we had our depletion unit. So our total cost basis that we can apply to that $5,000 sale is $10,002. Well, in that case, you actually report a loss. Okay. Again, that might be really advantageous to you depending on your circumstances. It might not be. In that case, right, then, you want to try to time these sorts of things. If you're going to blend, then you want to know, okay, when am I going to have income that I'm going to be able to, if say I have a business, that I'm going to be able to maximize the use of this loss as much as possible. Okay. You don't want to get to this point and then go, oh, well, I'd rather have taken a loss 5 years from now and not now. They're not gonna look too kindly on you saying, well, hey, just kidding. I want to unblend these accounts and not take a loss because I want my pulpwood depletion unit to be smaller, so I take less basis. Now, you don't have to take the loss, but if you don't, right, there's consequences for that too. You don't get to utilize it at a future time. You either take it now or you lose it. If you do have a loss as an investor, when I say lose it, I should be careful there. If you have a loss as an investor of 5,000, you're capped at any particular year If you have more capital losses than you have gains for a given year, then you can claim up to 3,000 of those losses and deduct them against other types of income, such as wage or salary income if you're an investor. If you have more capital losses than that, then you're allowed to carry the excess forward into future years. But the point being is, right, there are more restrictions on that. There is no time limit on using those capital loss deductions that you've carried forward. But again, as time goes on, right, and depending on what your tax circumstances are from one year to the next, it might be advantageous more so, it might be less. So you just need to know where you are in terms of, your income. Are you in your income producing years? Do you still work, or do you not working? Are you retired? That can complicate a lot of the stuff as well. If you're a business, this really shouldn't be a problem. In fact, it might be really, really beneficial. But again, as a business, you don't want to be declaring losses very often, right? So you still want to make sure if you're declaring losses, it's not going to be a profitable business, right? So it's just some tricky stuff there as well. But nonetheless, that's how you would determine what your basis that you could deduct from that sale would be. So you'd be within your legal rights to take that. Okay. And also, don't forget, not just the 10,000, but any sales expenses. So again, like we said, if you have any sorts of expenses that go along with the sale, such as appraisal or timber crews, things like that, you get to deduct those from the overall sale price as well. Okay, so how often do you update the Form T? Update before you make your timber sale, update when you sell the timber, update when you have a deductible loss, and update when you reforest or have another capital investment. As far as recommendations, these are fairly straightforward. It's very important that accurate and up-to-date records are maintained. You can go to this link right here, and it'll allow you to see, okay, in what particular circumstances do I need to keep records, 1 to 3 years, 6 years, 7 years, or even in some cases even longer. There's not a particular rule of thumb for all circumstances, so you'll want to go to that to get a better idea. There's about 7 or 8 that's listed. Form T is very highly recommended. It's not always required, but I would maintain those records as if they were required, because again, you don't have to file the stuff, but it's always nice to be able, if you're audited or questions arise, it's always nice to be able to show, hey, I've been keeping good books, and here's everything, right? I'm being deliberate, I'm being obvious, and nothing's on the being hidden or not trying to cut any corners. References that you might want to look at, as I mentioned, this Straka or Bullard Straka book. It's free online, quite a beast, but about 300 some pages. But pretty much anything on valuing timber is in there. So really good resource, and it's free. So very little cost to you other than just the download. IRS Form T Timber Activity Schedule. That's what we've been going through today. And there's an instruction form that goes along with that's nice to have. I've covered quite a bit of those instructions today, but it's not been in total. And then lastly, that Hardwood Timber Industry Audit Technique Guide, also through the IRS. That's really good if you're trying to figure out what fair market value is, what are appropriate techniques for establishing that, what are appropriate for doing a retroactive basis. Other references, as I mentioned, if you are interested in tax implications of storm damage timber, really how basis interacts with a casualty event, then this this link is for you. And if you go to this MSU Extension Forestry videos, there's a whole bunch of videos that we've been doing since the COVID outbreak that you might find useful. Some things are tax-based, some things are silviculture based, and there's quite a lot of good information there, and it's just good to follow that Facebook account, just for updates and publications or presentations that we put up there. As for the presentation today, if you want some written material, please go see this MSU Extension publication, 1983. It's 8 pages, but it covers basically what I covered today, just in words, and it gives you more time to digest it. And this is through Dr. Henderson, Dr. Steve Dickey, and Deborah Gaddis. This is a really good document. It's a good read if you have the time and the interest to put into it. You can see the link there as well. If you can't access these links yourself, please shoot me an email, as I mentioned earlier, smt489@msstate.edu, and I'll be happy to provide them to you. With that, I will end the presentation, and I just want to say thank you for attending, and hope you enjoyed the presentation. And if you have more questions, please feel free to contact me either by phone or by email, and I'm happy to walk you through anything I can. All right, well, for Mississippi State Forestry Extension, thank you. Have a great day.